Good afternoon, ladies and gentlemen. This is Robert Rayburn here at Life Pro Asset Management. It is February 26th of 2023. Hard to believe, but we are at the last week of February, 2 months into 2024. It's certainly been a interesting ride so far this year. Markets are up modestly. We're up modestly. There's components of the market that are in what we would call that bubble manic phase of the business cycle. And then there's other areas that are, relatively cheap. And so we're going to go through what a lot of those different moving parts mean, not just to the market, but to our clients and their portfolios, and ultimately how we're navigating a market like this throughout the course of the year. But most importantly, in the present, right here and right now. So let's go ahead and get started. I'm going to share my screen here. And as I do every week, we're going to start with that very first slide here in terms of the title. And this week we're calling this Navigating the Nvidia Bubble, right? And I was asked an interesting question the other day, which was, over the last, I'll call it 6 to 12 months, we've made some good transitions, but have there been any regrets? And certainly we look at within the technology space, two stocks that were definitely cheap at the bottom were Nvidia and Meta. And those are ones that we didn't play, right? And, I think that right now, people who are chasing Nvidia at these levels, you have to distinguish, did you miss a move and are you chasing, or do you truly believe that there is value creation over and above these price levels? And we also have to separate rhetoric versus actual price value. And I think a lot of people mix or conflate that, oh, hey, I'm not going to buy a stock or I'm going to sell a stock means I don't like the company. And Nvidia is a classic case of that, where it's a fantastic company. It's a great company. It's well led, one of the best leaders of all time in terms of corporate leadership. But the stock is really, really expensive. We're going to go and we'll walk through our reasons why we're very concerned about Nvidia at these price levels. But why we think that the AI revolution will actually create huge economic gains for the US. But Nvidia itself and some of its peers that are rallying, that in itself might be a bubble there. Number two, we want to talk about all this cash is sitting on the sidelines. When we think of that bearish view that is pervasive on the internet and across different media forums, they're forgetting the fact that they themselves are sort of creating this bullish trap that they've set themselves up for, which is all this cash is sitting on the sidelines. And so when you strip out that Magnificent Seven, valuations do remain quite attractive. We'll go through that. And then lastly, that creeping inflation that we continue to see perking back into the data. Historically, when we see that type of inflation data, when we see rates on the long end of the curve start to move up, that tends to, it's not guaranteed, of course, but tends to lead to value stocks outperforming growth stocks. And that's how we've positioned portfolios here in 2024. So S&P 500, it's overbought, right? No ifs or buts about that. But one theme that we've been very consistent on is that bull markets spend most of their time in an overbought condition. So we have to be really careful between saying, hey, I think this is the end of the cycle and we're going into a bear market, and I'm either going to try to raise cash or go short the market, or I think this is a 5 to 10% correction within a bullish trend. Those 5 to 10% corrections are really hard to time. Actually, all of the down moves are hard to time, but those 5 to 10% corrections are hard to time. And very few people make money on that. So what we have to do is really have to say, okay, underneath the hood of the market, underneath the surface of the market, are the symptoms positive or are they negative? And if they're negative, and we're pairing that up with an overbought or manic condition on top of the market, then that's where we can take some decisive action to reduce risk. But the reality is, and I love this phrase from FS Insight this week, this meme, but it was just like you have this angry bear out there. You know, these people that have been consistently and persistently bearish, right? And as a result of that, they have refused to get into the market. And you've seen that cash pile up on the sidelines. They'll come up with all these charts and overlays and everything else as to why the market should collapse. But the reality is the economy remains healthy, credit remains sound, and earnings have been coming in pretty decently. And when you strip out Mag 7, valuations are actually okay. So yes, the market's short-term overbought. And yes, we actually could see the market pull back maybe 5% or maybe a little bit more than that. But that happens during bull markets. Bull markets often see 1 to 2 corrections per year. So we have to distinguish correction versus end of cycle. And you can see here on the chart, just a ton of cash, $6 trillion of cash sitting on the sidelines. The end of bull markets tend to see these cash reserve drained, right? In other words, classic buy or sell. If you run out of buying power, the only power that's left are the sellers. We're just not seeing that right now. So you got the skepticism plus these high cash amounts. That tends to provide a solid foundation for bull markets. And the longer that this bullish condition drags out for, the higher the likelihood that this cash is going to get dragged in because of that fear of missing out. And that's a real condition in the market. We call that a performance chase. In modern lingo, that's called FOMO, right? That fear of missing out. Now, I wanted to show two distinct ways of looking at market symptoms, okay? So real quickly, what do we expect to see in a healthy versus a not healthy market? In a not healthy market, we would expect to see clear breakouts from consumer staples. So these are like food stocks and Coca-Cola and stuff that people buy regardless of expansion or recession. Utilities, right? We need electricity in our house no matter what. So utilities tend to outperform in the approaches of a recession or as a recession comes closer or during a recession. Right now, what we see is a clear breakdown in both of these defensive sectors. So you have a breakdown in the defensive sector. Meanwhile, the offensive sectors, such as consumer discretionary, they were talking high price goods that we don't need to buy, right? When we feel good about our economic situation, we tend to splurge a little bit. These are the types that we call this the splurge stocks, right? So these are the types of stocks that do well when people feel comfortable to spend a little bit more than they typically do. They are breaking out to the upside. Transports, right? Think of rails and trucking. What are they shipping? They're shipping goods. What are goods? Well, the stuff that we buy, right? So if we are spending a little bit more, guess what? Those retailers are transporting a little bit more throughout the system. So this is what we call the economic sensitive part of the market. Those are breaking out, and they're breaking out relative to staples, relative to utilities. So going back here, recession stocks breaking down, and economically sensitive parts of the market breaking out to the upside. That's what we look at in terms of symptoms, right? Then we look at inflation. So inflation is the one area that really has not been contained yet. So growth looks good. Unemployment looks good. Non-farm payrolls continues to build up. All that looks good. The one blemish on the economy remains inflation. And it's the one area where everyone's piled into this idea that the war on inflation has been won. It's not quite true. So when we look at the monthly CPI, since October, that has been creeping up. It's gone from 0.1 to 0.3, which equates to just under around 4% annualized inflation. 4% is double the Fed's target of 2. So if you start to cut rates at 4, you're not going to reach 2. So goes economic theory. You're going to get the 5 or 6% inflation, which means they got to really hike interest rates at that point. That was the mistake made in the 70s. They cut rates too soon. And if we look at what we call common man inflation, right? So that would be like your food, your energy, shelter, clothing, utilities, insurance. That has really started to accelerate again. And these are the inflation factors that the average American feels every single day, that they see when they go to the grocery store, the gas pump, or their insurance rates. I can say Like my wife and I, we looked at our auto insurance rates, and I've actually never even had an accident before and haven't had a ticket in 20 years, and our insurance rates went up, right? You notice it. It hits you as soon as you open that bill. So in this type of market, where do we see value? There's four distinct areas that really excite us about the market right now, both in terms of price and in terms of earnings. So bank and diversified financials, valuations are attractive. We see earnings picking up as it relates to higher interest rates, but most importantly, net interest margins continue to expand. Energy companies, we're starting to see consolidation in the shale space, the emergence of big shale. That's important because a lot of the acquisitions that have taken place have been in the private market, and the private market's been responsible for some of that production increase we saw out of the US. Number three, emerging markets in China. Valuations are dirt cheap, and growth is picking up across that part of the world. And we really like two orphaned growth stories in particular, which are Chinese stocks and cannabis. These are areas that were flying a couple years ago. They've pulled back anywhere from 50 to 70 or 80%. So that's not a pullback, that's a collapse. And these are areas where the valuations are there and the growth is there, and there's clear identifiable catalysts to unlock that value. And we see that in the energy charts here. We had a couple what we call two standard deviation moves in terms of those daily moves over the last week in energy. And we see the equal weight here trying to break out of this recent consolidation. And we look at energy relative to the S&P 500, again, trying to break out. So, and we've seen individual names. We won't go into those names right now, but names that have been beneficiaries of merger and acquisition activity. And we just think that valuations there are ripe to expand, not just because the price of oil has gone from 72 to 78, but because we're dealing with a consolidation in the energy space, which is just going to supercharge that production discipline that we're seeing here stateside. US banks, same deal. We have margins expanding at the business level and solid credit, right? So when we look at credit spreads, whether we're talking high yield financial spreads, or we're looking at investment grade credit spreads, both are narrowing, right? You want to see those down because that's a sign of risk. So you want risk down, not up. So this is good. And of course, the equal weight financials sector continues to break out. And I think this is important because they're breaking out despite all of the rhetoric around commercial real estate. And I think it's important to remember that commercial real estate is not residential real estate. Residential real estate is one of the largest asset classes on the planet, and everyone had exposure to it during 2007, 2008. That's just not the case on the commercial real estate side. And then when we include cheap valuations, again, there's a theme here: cheap price, good valuations, and rising earnings. That really sets us up for success, in our opinion. And then, of course, we've spent time on China, right? So Chinese market, 48% drawdown in terms of the total market, right? So S&P 500 in 2008 went down about 53% in terms of peak to trough drawdown. So very similar to that 2008 type of situation. Everyone is negative. Hong Kong is over, those types of statements. That's when you want to start sharpening your pencils. That's when you want to start doing your homework and say, hey, are there some really good Facebook-like companies or Google-like companies that are available not at 30 or 40 or 50, or in Nvidia's case is 100 times earnings, but are available at 8 times earnings? And there are. And that's where we've been doing a lot of homework recently. So what's interesting is, despite the fact that pessimism is off the charts for China, we've started to see some breakouts, right? Hong Kong has recently broken out of its downward trend. China, same deal. And this is just 1 week's worth of action. We think there's a lot more to go here, especially we believe at some point China is going to respond with massive economic stimulus. And we're starting to see the currency markets sniff this out. So when this chart goes down, that means the Chinese renminbi, their currency, is breaking out. In other words, it's getting stronger relative to the US dollar. The US dollar is getting weaker relative to the renminbi. And we're starting to see signs that that currency is strengthening relative to the US dollar. Even at the center of the Chinese storm, which is the financial and real estate market, you're seeing banks break out. Again, bank sentiment in China, this picture says it all. Their stocks are starting to break out and go the other way. So again, these are clues that the end of the world scenario has been priced in, and you're starting to see the survivors, where the market's already saying no matter what happens, these companies will survive. Those are starting to find buyers. Now, on the other side of this value equation is what we call the bubble equation, right? And of course, we believe that centers around the Magnificent Seven. We are very, very, very contrarian in this view. Everyone and their grandmother and their grandfather owns these stocks. We hear statements like there is no way Nvidia can go down. It's a sure thing. It's the magic bullet. You are dumb if you don't own it, right? Well, maybe we are, right? But let me walk you through an analogy or not really an analogy, but a similar story that's very analogous with what we're going through today. Cisco, very similar to Nvidia, benefited from the rise of the internet in the 1990s. They sell switches and routers. The switches and routers were the prime equipment pieces that we needed to direct data packets, or in other words, traffic flow on the internet. Hey, traffic is going from A to B. We need to direct it the right way, and the routers are what directs that traffic, right? Kind of consider it almost like stoplights, directing traffic one way or the other. Everyone who is fixed to the internet on the back end needed that. Anyone who is dealing with connecting to the internet needed these components, whether at the corporate level, personal level, at the telecom level, you needed this equipment. Cisco was identified as the company that would win the internet, and they did win the internet. They, to this day, are one of the top equipment providers. But here's the problem. In the late 90s, you had this massive build out, this huge build out. And then everyone sort of satisfied their quotas, right? The big build out started to slow down because you reached capacity. And Cisco's stock collapsed, along with many technology stocks in 2000. And it wasn't because it was suddenly a bad company. It just happened to be that those big enterprise customers finally fulfilled their needs, right? And a lot of them in the lead up to 2000 double and triple ordered. And so when they met their quotas, guess what? They started to cut back their 2000 orders, their 2001 orders. And with Nvidia, we have to remember it's a chip company. It's a fantastic chip company, one of the greatest companies of all time. But they are a chip company, and they're selling multi-purpose chips, GPUs, right? And that infrastructure is designed to basically replace the old way of computing towards inference computing. It requires a lot more power, multi-purpose abilities at the chip level. It's so important to remember, though, that the biggest customers there, like Meta and Google, at some point are going to meet their requirements in terms of growth rate. And as they meet most of those requirements in the early stages, as the build-up nears completion, they're going to have to scale those orders back. It doesn't mean that AI is not going to happen. It doesn't mean that AI is not a thing. It just means that the huge build-out, the rush to build everything out, the panic building is going to slow down. And we saw the same thing in China, right? Where in the 2000s, infrastructure and commodities rallied until, guess what? China ran out of roads to build. China ran out of airports to build. And we had all this supply of commodities that had been built out to respond, and we had to cut back orders, and you saw commodities drop. So just important to remember that within the Magnificent Seven space, Apple and Google are already showing signs of breaking down. Tesla has broken down. We didn't put that chart this week, but Tesla has already completely broken down. So you're starting to see those cracks. We just need to be really careful. So in summary, price matters. That's the big lesson. The US market is overbought, but it is well supported by a wall of cash. The Magnificent Seven bubble is narrowing to just the Nvidia bubble. We need to be really careful when we see that narrowing breadth in any group. And then lastly, energy, emerging markets, and banks look super attractive to us. And that's what we got for you this week. So if you have any questions, 888-543-3776, please feel free to reach out to your advisor and have a fantastic week. Thank you.